Hey everyone, Scott Grant with Standfast Asset Management, and it's 6:22 on a Thursday, which means we're going to do another tutorial on investing. And tonight we're going to talk about numbers. We're going to play some number games. And during the promo, I put some numbers on the board, and I think they're fun, so I'm going to start with that. Let's suppose that you invested $100, and that in the first year, you made a return of 50%. So first off, you're really happy because 50% is a great return. But in the next year, you lose 50%. So the question is, it's how much money do you have at the end? You make 50% one year and you lose 50% the next year. I'm going to pause a second, let you think about it. Text us with your answers if you have one. So the most common response to this question is, how much do you have left at the end? Is you're even. You got $100. You went up 50, you're down 50. Well, that's not true. In fact, you lose money. So your 100 goes up 50%, you have $150. Now you're going to lose half of that. And obviously half of 150 is $75. So in this scenario, you actually have lost 25%. That's one of the reasons that Warren Buffett's rule number one is never lose money. Rule number two is never forget rule number one. Now what's interesting is it works in reverse. So if we take the same fictitious $100 and we take it down 50% and then up 50%, we end up back at 75. You go down 50%, you lose half of $100, you have $50, and $50 grows 50%, you're at 75. And that's because multiplication and division are commutative. In fact, if you lose 50% in the first year, you need to make 100% to get back even. If you, in a less severe scenario, were to say lose 25%, so in this case you go down to 75, the next year, or over the next several years perhaps, you would need to make 33% to get back to even. Downs hurt, declines hurt, and I'm going to give you one more. Again, say you have $100 and you make 8%, and then you make 8% again, and then you make 8% again, and then you lose 12. Make 8 again. Make 8 again. Yep. And then you lose 12, and you lose 5. And by the way, you can put these, much like the 50% example, you can put these numbers in any order you want. You always end up with the same result. So basically I have 7 positive years of 8%, 2 negative years of 12, and 1 really bad year of 25%, but I got 7 up years. And the question is, are you, at the end of this, are you ahead or behind? Pause a second and remind you that the reason I'm doing this is to share knowledge that I've developed over 3+ decades. In fact, I've been in this business of managing money professionally longer than I care to imagine. And people often ask me, what is it that I do, because they know me from the newspaper columns and the radio show and some of the historical presentations I do. So I'm sharing some of the knowledge that I have garnered in a career of managing money. And by the way, so did you guess positive or negative? Did anybody guess? No? The answer is you're about even. You have $99.50 left. Down 50 cents, which after 10 years would be good. So why am I even thinking about doing this if the potential for loss is so disastrous? And the reason is that I need to accumulate a lot of money to live off of in retirement. We all do. Social Security is not going to take care of us in retirement. We all need to make as much as we can in order to live in retirement. And so and to make that, we need the higher rates of return. So let me do a quick one here. Suppose that I invested $1,000 a month for 40 years. 40 years sounds a little like a prison term, but it's also about the amount of time most people work. 1,000 a month is a big number. And I did not want any risk. So I got a 2% interest rate, someplace guaranteed. I'm not sure you can get a 2% interest rate guaranteed right now, but let's just say that you could. At the end of the period, you'd have $734,000. And you're going to have to take my word for that, or you can do the math at home. Check me. So, $1,000 a month's a lot. $734,000 is a big number, but it's not a gigantic number. What if we could increase the interest rate to 8% and decrease the amount to $210 a month? Well, at the end of the period, we'd have $733,000. Almost as much as putting away the $1,000. And by the way, that $1,000 a month for 40 years is $480,000 of your own money. And at the end, you had the $734. Here, with a higher rate of return of 8%, we end up at $733, but only putting away $210 a month. I'm kind of digging the whiteboard. So 8%. So why do we use 8%? It's a number everybody in this industry uses. As far as I know, the SEC, the organizations that monitor us, like that number. It is worth pointing out, and I should do a disclaimer at least once during the show, investments can and do lose money. We're talking about investments. We're talking about stock market investments. That's where we can get, where we hope to get a big portion of this return. They can lose money. People lose money all the time. You should consult your financial advisor before ever making a financial investment. But 8% is the common number to use. Okay. So what we need to do is to reduce risk. And there's really three ways to do that. One is what they call the pie chart approach. And I'm sure you've seen these things. Set up this chart, and then, one of these is large cap U.S. companies, and one's small cap, and one's gold or Bitcoin, and one's high yield bonds, and conservative short-term bonds, and foreign stocks. And this whole pie chart idea was invented by a guy named Harry Markowitz. He wrote the paper. Later in the 1990s, he won a Nobel Prize for this pie chart. You'll see it a lot. To me, it's somewhat unwieldy. It's not my favorite way to do it, but I think it's a viable alternative. Markowitz waited from the late 50s into the early 1990s to get his Nobel Prize. And that's the normal for Nobel Prizes. People do the work, decades go by, then they finally get the award. There was a recent TV show, Big Bang Theory. And in the Big Bang Theory, two of the scientists got a Nobel Prize the same year they wrote the paper. Doesn't happen that way. In fact, Einstein writes his Nobel Prize winning work in 1905. He doesn't receive the Nobel Prize until 1922. Along the way, he gets divorced, and he's so certain he's going to win the Nobel Prize that he gives the prize to his soon-to-be ex-wife. She's so confident that she makes it part of the divorce decree, and they notarize it. In fact, he doesn't give it to her, he leaves it to her in trust. She gets the income, his kids from that marriage get the remainder of the Nobel Prize. But Einstein was that convinced that he made it part of his divorce. The other option is what they call the random walk. Wow. I suspect I probably did better in mathematics and when I was in grade school than I did in the handwriting. Just look at it that. But in any event, the random walk, and that says you just invest in the S&P, you invest in the broad market, and you forget it. And that's not a bad strategy either. We use a third strategy. We tend to identify specific companies that we want to own that are kind of conservative by and large, and we grow from there. But all those things are designed to reduce risk during this time. My daughter took a new job recently at a big hotel chain, and we were talking about her 401k. The other way that you can reduce risk is to do what they call dollar cost averaging, and that's where you put money in to an investment account, say every month. And earlier I was using an example of $1,000 a month, which is a lot. But if you did $1,000 a month for 40 years, at 8%, you'd end up with $3.5 million, which is a decent start toward retirement, if not a complete retirement. Say, oh, I can't afford $12,000 a year, and you're probably right. But you might be able to afford an IRA contribution every year, and that's $6,000 or $500 a month, $6,000 a year or $500 a month, which works out to be about $1.75 million at retirement. That's not bad either. So when you're starting off and you're putting away a certain amount of money a month, whether it's into a 401k or an account that you create on your own, like an IRA, you actually want the investment, the value of what you're investing in to go down. That seems totally counterintuitive, but it's true. And the reason is that the value of your future contributions is greater than the value of what you have in here. So ideally what you want to do is just keep investing, 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 investing. Probably someplace down here you're also pulling out your hair, wringing your hands. But what happens is your average cost keeps going down, and eventually the market goes back up. It always has in the past. There's no guarantee it will in the future just because it has for the past 100 years or so. But that's what happened. And you keep buying as it's going up, and your cost starts raising, but you end up with a lower cost because the accounts went down to begin with. That's tonight's presentation. We'll be back next Thursday at 6:22. I urge you to follow us on Facebook and on YouTube and Instagram to see these kind of presentations. I'll probably do these for the next couple months, and then I'll be done.
Standfast is a fiduciary asset manager specializing in great American companies.